Okay, welcome class. We're in module 9 now. Chapter 7, variance analysis, DM and DL variances, means direct materials and direct labor variances. So likely review, almost certainly you've gone over something about variances and standard costing in your intro to managerial accounting class, here or elsewhere. Hopefully we review the nature of it because it's quick to be forgotten. And hopefully we add on additional information specifically about the journal entries. Now, for those who aren't accounting majors, you might say, well, that's the least important part to me. So be it. I still think you might find some value there and understand how, at the very least, you'll take away that this system can run largely on its own or a lot of the parts of the system run on its own through the general ledger, through the journal entries. And then next week, we'll continue with Chapter 7, talking about, and I meant to fix this, talking about overhead variances and mix yield variances. There are the two quizzes, which are almost ready to be taken next week. Just like back in Chapter 3 and Chapter 5, two quizzes that have like about half the material each. Okay, so let's keep talking about direct material and direct labor variances. They provide the easiest to access and understand variances that we're talking about. So the illustration I have is the big mountain range up here. Way over here on the right-hand side is what we thought we would incur. Let's just jump into direct labor. We're going to do that first. Direct labor. Let's say this is the amount of direct labor cost we thought back in the static budget when we made that static budget at September of last year or something. That's the amount of, based on our standards of, well, we're expecting this number of finished goods. That means, because we expect so many hours of direct labor per finished good, this number of direct labor hours, and our standard amount, so that would be a standard quantity, how many direct labor hours there are per finished good, and the standard of how many dollars it costs us per direct labor hour or direct labor price. That's our third standard. Between those three, we can figure out what the direct labor price or cost, the overall direct labor cost in our static budget will be. That's what we did back in September of the previous year to get the annual budget, the static budget. And in fact, those are the three general standards, building blocks of any budget. We have some question of volume. We have some translation of that overall volume into the specific category we're talking about, direct labor in this case, standard quantity. And then we also have a price per unit of the cost category we're talking about, direct labor price in this case. And it just happens to be that we have three variances with those three different levers we can pull. So we had this assumption. The first assumption we're going to relax and change is the assumption of the overall volume to get the volume variance. Well, back then we thought we were going to produce and sell 10,000 units. That was our budgeted quantity of direct labor hours, was based on the idea that we thought it takes about a half hour of direct labor hours to produce a single unit. So 10,000 units to sell means that we would have 5,000 direct labor hours. 10,000 times 0.5 equals 5,000 direct labor hours. That was a budgeted quantity in the static budget. Well, we can take that volume assumption was wrong in some way, so we can move from our expectation of that volume over to the actual overall volume and say, oh, well, we really produced and sold 12,000 units. Given our standard quantity of 0.5 direct labor hours per unit, that suggests we should use this period, it's a flexible budget, 6,000 direct labor hours. If we had known, if we had the time machine, somebody came back and said, oh, don't budget 10,000 finished goods units, budget 12,000, that's the actual number, then that would be our flexible budget. And now we have trued it up to this point. We've taken out the volume variance. We have a dollar amount right here that reflects how much the number of direct labor cost overall has moved from the static budget to the flexible budget by moving towards what we actually did in volume. And then we can go do the same thing with quantity. How many direct labor hours did we actually use? Did we use 0.5 direct labor hours per finished goods unit, or did we use 0.47? Did we use 0.6? Did we use more direct labor hours or fewer direct labor hours than expected. So we're moving from our budgeted quantity here to an actual quantity of direct labor hours. Still at the budgeted price, though. We hold that constant. You have to hold that constant. Don't move two things at once. It's called a confound. That's what I was describing before about being it would be very unscientific to do that. I described that Thursday. You want to be pulling just one lever at a time, because then you can say, the difference is likely, if not certainly, due to that lever I'm pulling. So we've changed quantity, we get the quantity variance. Hold quantity constant now, actual quantity here, because now we're going to pull the price lever. Okay, well, how much did direct labor cost us actually? That's the actual price right here versus how much we expected it to cost us. Change that, it changes the cost amount. And finally, we're up to actuals right here. Okay, now we have, as a result of that, we have equations. And you have two equations for each variance, because some of you would prefer the equation that maps directly to this visual. And more power to you. That's fine. That's great. I tend to do the other way. I tend to like the other equation. But literally, if you take these two italicized terms inside the rectangle and multiply them, then you have a dollar amount in each of these boxes. And then if you take each mountain and subtract, so you have actual direct labor cost in this example, the actual direct labor cost minus the direct labor cost if we had actual quantity times the budgeted price, this rectangle right here, subtract across rectangles, you end up with the variances. That would be our price variance. So actual quantity times actual price minus actual quantity times budgeted price gives us the price variance. And so we go down, that's what the equation says, right? Well, when we get to that, right here, direct labor price variance, actual hours, actual quantity times actual price. That's the rectangle at the far left of the diagram, minus actual quantity, still holding that constant from here to here, times the budgeted price. So the only thing we're changing is the price here. And I like the algebraically rearranged version of that. You can take this actual hours, actual quantity that is, and pull it outside the parentheses, create parentheses here, and just have actual price minus budgeted price scaled or times actual quantity or actual direct labor hours. In this case. I like that. It's a more algebraic version. I think I'll usually call it that when I refer to it. And I tend to default to this. It's one less step. I don't have to multiply, subtract. I have to subtract. Instead, I just subtract, then multiply. I just have one. I have one less arithmetic function I have to do. Okay, same with the quantity variance here. We have this rectangle right here, which is actual quantity times budgeted price or standard price. Again, standard, budgeted, expected, they're all interchangeable. They mean the same thing, or effectively the same thing. And over here we have our flexible budget, which is the budgeted quantity at actual volume of production, of finished goods production, times the budgeted price. And that is reflected here in the equation. So direct labor quantity variance, we have actual quantity of hours times the budgeted price. That's the rectangle there. I call it the quasi-budget in the diagram. And we have budgeted direct labor hours times budgeted price. So the expected hours times the expected price. So we've changed the hours, changed the quantity of our direct labor, in this case, because of direct labor variance. So naturally, the output of that subtraction is going to be the quantity variance, because that's the lever we're pulling. Therefore, it has the name quantity variance. You can algebraically rearrange that, pull out the budgeted price, because that's the same in these two products terms right here. Pull it on the outside and create parentheses. It just has these two inside, and you have this equation right here. Actual direct labor hours, actual quantity that is, minus budgeted direct labor hours, or budgeted quantity, and that difference times the budgeted price. Now, keeping in mind the diagram is useful because it keeps the difference operation you're doing in the right order. There is a right order and a wrong order, especially if you're going to learn favorability based on the sign of the number, positive or negative. Some of you will want to do that. I don't typically do that. I have to think through the logic. I like thinking through the logic of it to make sure I've got my head on straight here and didn't make a mathematical mistake that leads me to think something favorable that's unfavorable, or vice versa. But the idea is we're on a journey from the most hypothetical to the most actual. And we're just step by step moving from pretend land towards reality. And if we step towards reality and the costs go up, that's unfavorable. If we step towards reality and costs go down, it's lower than we thought it was going to be, that's favorable. We're doing cost variances almost exclusively here. Next week, there are some mix variance questions that talk about revenue variances. And there are revenue variances, but we just spend most of the time on cost variances because that's the nature of most variance analysis systems, is they focus most of their time on that. So we teach to that. So the idea is if we had a static budget of, 10,000 quantity, 5,000 hours times, let's just say $10 per hour. So that'd be $50,000. Is this what's in this rectangle right here? 5,000 times 10. And we had instead, based on actual volume, we should have budgeted 6,000 hours. We would have budgeted 6,000 direct labor hours if we knew we were going to produce 12,000 finished goods units, times the budget price of $10. We have 60,000 right here. So from our most hypothetical to, not quite as hypothetical because it incorporates the actual volume of finished goods production we had, our costs went up from 50,000 to 60,000. So 60,000, that means our volume variance is going to be 60,000 minus 50,000. Can you keep it visually in the same order here? Just translate that directly into, and that'll give us the volume variance of 10,000. But is that a good volume variance or a bad volume variance? It's unfavorable. We went more towards reality. Now we incorporated the real and actual volume of finished goods, and our costs went up. So that's technically an unfavorable. I say technically because I'm going to talk about that in just a second. It's an unfavorable variance, and this is the rule. Positive variances are unfavorable. If you follow which side of the difference operation things are on, just like the diagram here, your positive numbers will be unfavorable variances. Negative numbers will be favorable variances. To help reinforce that, let's talk about what we do with this number in the journal entries and in the general ledger. This 10,000 isn't just there in some spreadsheet. It's going to be reflected in what we record into the general ledger. So at the end of the day, we're going to debit, when we have this, 10,000. Learn how to do journal entries again. 10,000, the name of the account goes here. Volume, DL, volume variance account. I'll get rid of account, make it nicer. The direct labor volume variance account. It's an expense account. Expenses go up with a debit, down with a credit. So we're going to be debiting. It's positive, so we're adding it to the volume variance account, this expense account, with a debit. And maybe that helps reinforce, interlock a variety of nodes together so you remember it more easily. That goes together. That's going to be part of that journal entry when we record our variances. Okay. So let's step back for a second. Let's go to the example in the book. I want to go through this example that's worked out here. All right, so what happens is you are the company here. You use some labor. You have people working for you. They want to be paid, right? It's so selfish of them. They want to be paid. You promised them to pay them, actually. That was short-sighted of you. So you're going to debit wage expense because now you've incurred the expense. It's accrual accounting now. We're in an accrual accounting situation. So wage expense, the amount we owe them is $11,500 in this example. We credit wages payable $11,500. That's the actual cost of direct labor. So the far left-hand side of that mountain range, it's actual, $11,500. You always credit the payable the actual amount. If you don't, there's a word for that. Jail time. Yeah, you record your debts at what you actually owe your debts, or that's bad. There's your financial accounting lesson for the day. Okay, so the wages payable amount is always going to be at the actual. And it's reflected in the wages expense as well. This amount here. But then, between the wage expense and what actually hits the inventory account on the balance sheet, we're going to translate it into the standard amount we would have paid based on our standards of direct labor, standard quantity, standard price, in work in process here. So that's going to be the debit on the top here. So your credit here is going to reflect the fact, just through the wage expenses, it's passing through, if you will, to the balance sheet side here that's actual. And the debit to WIP is going to be at full standard. That's the way we're going to do standard costing in this class. You can technically do it different ways. So I'll lay it out right here, just for real quick here. So you have different inventory accounts that tend to go in a chain. You have raw materials, you have work in process, you have finished goods, and then it jumps away from inventory to the income statement, and you have cost of goods sold, which goes on eventually to retained earnings and so on and so forth. But these three inventory accounts go in a chain, and you can technically start at full standard here, get it to standard cost, or here, or here. The point is on the income statement, if you're using a standard costing system, you eventually have your cost of goods sold at standard. It's simpler, and I'm pretty sure, I haven't kept too close of a pulse on industry about this one, but I'm pretty sure it's still true, that if you're using standard costing, you almost always just put it at the very beginning there at WIP. So that's what we're going to do the entire class. That's going to be one of the rules of thumb here. In fact, that's it right there. Rule of thumb for variance analysis. In the full version of standard costing that this textbook covers, which is, I pointed myself, I am the textbook, which we're going to cover in this class. That's what I'm saying, we, I guess. Costs debited to WIP are always at the standard cost. So the point here is, if we go back up to the text that goes into this, we have a standard of $8 an hour as our cost for direct labor. That's a direct labor price of $8 an hour. And a standard quantity of 1,000 hours. I did something there, and I want to remember in a second. I'll come back to it. And so when we have that, when we have the standard price times the standard quantity, that's full standard then, it's at $8,000. One more thing I also remember. So that's what it means. We're going to debit $8,000 to work in process, and that means that we have to have plug lines in the journal entry here to the different variance accounts. Again, these are expense accounts, and so if we're debiting to them, that means we're increasing the expenses. That's unfavorable. All things being equal, more expense is less than less expense. That's your second important lesson you didn't know before, sarcastically speaking. Okay, so the way this works is you could very simply say, look, I know my actual costs, and based on the standards of $8 direct, $8 is the labor price, standard price, times, I have to scroll one more up, times 1,000 hours as the standard quantity. I have 8,000 here. With direct labor, that presents a problem. It's not true for direct materials. That's why I said it for direct labor. You know that the overall amount between these two variances is going to be a debit of $3,500 to bridge the $11,500 credit you have over here and the $8,000 debit you have over here. Total, you're going to have $3,500 extra debits because, in accounting land, if you're not an accounting major, there's a reminder, you have to balance the debits and credits or the world ends. But we have to balance these. So the problem is we don't know the balance without calculating the the variances. In direct labor, you have one giant entry you make when you incur the direct labor cost, when the people give you their labor. And so, yeah, I know I have 3,500 net debit that has to go here, but technically, if without calculating the actual variances, which I do in these two paragraphs right here, it could be 4,000 debit to quantity variance and 500 credit to price variance. It could be 24,000 over here and 20,500 over here in the credit line. The net has to be 3,500 debit. I don't know what it is. So I can't solve. There might be a question that actually hinges on this. I can't solve the variances with this because it's a 4-line entry and I only know 2 of them based on full standard and actual. With direct materials, actually, we end up using 2 entries. Each of the entries is 3 lines. And so there's much more room for you to play around and just using accounting logic say, oh, well, I know what the variance has to be because I know what the other 2 lines are. So having journal entries added to the variance analysis in a lot of ways, if you've got strong accounting instincts or strong enough accounting instincts, makes the problems easier to solve. You have an additional tool to bring to bear. All right, so let's look through here. All right, the details here are we incur. All right, here we are. Flexible budget, 4,000 units production. So that's actual units production. We would budget $8,000 for direct labor because of standard price of $8 and standard quantity of 0.25 hours per unit. So I have used standard quantity in 2 different ways. I referred to 1,000 direct labor hours of standard quantity, which was the 4,000 finished goods units times the 0.25 standard quantity per finished goods unit. I've referred to this as standard quantity, and just 5 minutes ago, I referred to this as standard quantity. This is our standard of direct labor per finished goods unit. They're both standard quantity. When you're using it in a calculation, you need to get it to the total amount. What is the standard total amount of direct labor hours we have? That's what I mean when I have in the boxes budgeted quantity or standard quantity here, the total amount. But it's called that because it's built off of the building block of the standard of 0.25 hours per unit. So we're going to call them both ways. Really, when I'm talking about standard quantity, I'm almost always referring to the total amount here. All right, so we know standard is 8,000, so we're going to be debiting. Once we get the timesheet, we know, well, once we know our volume, we know our standards from back when we did the original budget was $8 per hour, quarter hour per finished goods unit. So that means $8,000 should be our amount of cost that we incur, and that's what we're going to debit to work in process. So our actual value of inventory, just so you know what this means, our actual value of inventory sitting there on the factory floor. Let's say we had a fire and it was destroyed, and we're trying to figure out how much it's worth or whatever. We have to understand, if we're using standard costing, we have it on the books as $8,000 worth of direct labor there. That's not what it cost us. We have already carved out variances that it costs us $11,500 to get the direct labor for those goods that burned up or whatever. So we're creating a bit of a fiction. We're changing what we're valuing the inventory at while it's in process, and then where it is at finished goods, and what is valued at in cost of goods sold. So we're creating some noise in that measure that no longer reflects as closely what it actually was worth or cost us. But we're doing that for a management accounting purpose, so that we can hold people responsible for the variances that they have control over and try to optimize the performance next period. We're going to then take that variance that we pulled out for price variance, or the variance we pulled out for quantity variance, and call somebody up on the phone and say, hey, we have $2,000 of quantity variance. You're the person who scheduled those direct labor hours. How can we improve that next period? And maybe there'll be more colorful language on that phone call if $2,000 really is a lot of money here, or if we're scaling as this actually $2 million because they're all in thousands of dollars, then maybe we'll have a very different conversation. Or talking to the people who are hiring people in HR who are hiring and deciding, doing a lot of decision making in wages. Why does it cost so much? Why is our price variance so high? We're paying people more than we're expecting than the standard is. So that's the trade-off that we're making. We're making the inventory account. Oh, I went too far. We're making the inventory account less accurate. This inventory account here, for the sake of getting these two numbers, because we're going to use them for something to improve the profitability of the business in the future. Okay, and then moving on, so we have 8,000 as our debit to WIP. We know we actually incurred 11,500. It has to be recorded as actual cost. And then the plug is 3,500 debit somewhere. So when we calculate it out, let's calculate it out. Let's do our two variances just like we have in the text there. So as if it were a problem, let's write it up. We have actual price, actual quantity, standard price, standard quantity. Now this is $8 per direct labor hour, DLH. And this is 1,000 direct labor hours, which we got from 4,000 volume. I'm just going to call it the finished goods unit, times our standard of 0.25. Direct labor hours per finished goods unit. Okay. Now we know the actual total was 11,500, but if we need to break that down, so the actual quantity is 1,250. So we used 0.3125 per unit instead of 0.25 per unit, direct labor hours it is. It took us longer than we would have expected to get that many units produced. So our actual quantity was 1,250 and actual price $9.20. Okay, so now we can get our direct labor quantity variance, and we can get our direct labor price variance. We can do it two ways. So we're going to we can do it with the rectangles, and we can say direct labor quantity variance. Okay, so I'm over here on the mountain range, and the quantity variance is comparing this versus this, the quasi budget, as I called it, versus the flexible budget. So flexible budget is at full standard, which is the 8,000. That's 8 times 1,000. I'm just going to put it there. The quasi budget is, we're trying to get quantity, so I'm going to hold constant the price, and the only lever I'm pulling is the quantity. So I need to have standard price times actual quantity. So 8 times 1,250. Trying to stop scrolling up and down all the time, so I do the math on the phone. And that gets us 10,000. So, rewrite that. That's equal to $2,000. $2,000. So we have a debit of $2,000 in that illustration down below to our direct labor quantity variance. All right, we could do it also with the algebraic formula. So we can say the difference between actual quantity minus standard quantity is 250 times, or scaled by, the $8, and that gives me, again, $2,000. It works the same either way. It's your preference. Okay, so now let's talk about direct labor price variance. So it's price, we're going to be comparing the actual amount minus the quasi-budget amount. Now the actual amount we know is 11.5? That's what it was? Pretty sure that's the number. Yeah, 11.5. In my head I was thinking it might be 12.5. 11,500. Minus the quasi-budget, which we already sold for that right here. So that's the standard price times the actual quantity, 10,000. And that's where we get the $1,500 debit to direct labor price variance down below in the textbook. Okay, we can do it algebraically as well. We can say, look, we have actual price of $9.20 per hour. And we have a standard price of $8 per hour. And that leads to a $1.20 difference. And just scale that or multiply that by 1,250. And that does indeed equal 1,500, just like the other. So either method works. I think one of the reasons I like the algebraic method, besides it having one less arithmetic step I have to do, is I can see right here, it helps me double check, give myself a check figure on favorability. Because I have actual minus standard right here of the thing I'm comparing that matters. The one lever I'm pulling, it's right here in the parentheses. Actual price, higher than standard price. That's bad, unfavorable. Which means it's debiting. We're going to be debiting the account, the variance account. Right here, we use 1250 hours, where if we were on task, we would have used 1,000 hours to get that, to produce those 4,000 units. That means we have 2,000 hours unfavorable wasted time, if you will. That's kind of what that reflects. Okay, now, when I started explaining the pyramids here, I started at the very far right here at volume variance. And then in the problem here, and what we've done here, I've said the journal entry that records all the variances is the 4-line journal entry that includes the quantity and the price variance. I just ignored the volume variance. And that's basically what we're going to do. When I went through the volume variance earlier, that's good as an example, but I don't think I have a single question that asks you to solve for the volume variance. Also, I said something along the lines of it's technically unfavorable if you have higher volume and therefore your costs go up between static and flexible budget. Because, having more business is usually good. So yes, unfavorable that you had more cost because you had to produce more to serve more customers. But I think on net, unless you have severely discounted those customers' goods and you've sold it under cost, that means you're still going to be profitable overall. The point, though, the key is where volume variance, or let me say this, the way volume variance does come into play in the questions is, I think I said this Thursday too, I will give you information on the static budget sometimes, and you'll be tempted to compare this number and this number, and you will get, instead of the quantity variance, which is what the question is asking for, the quantity variance plus the volume variance, which is an unusable number. That's wriggleable. People can wriggle out of that. Call them up. Hey, got this bad quantity variance. No, actually, it's lots of its volume. It's unfavorable because we did a lot more work. Okay, I can't dispute that until I pull out the volume variance and say, yeah, even so, $2,000 worth of wasted time is still in your department. Where's that going? What can we do to improve that? Okay. And then I'll put the punctuation mark or the exclamation point right here on that. So, like I said at the very beginning, as promised in this chapter, the point of variance analysis is to compare actual results against expectations in such a way that it suggests a specific action or gets you very close to the suggesting a specific action. It lets you ask the right questions that will lead you to the right action for correction. So this doesn't tell me why that 2,000 is there, but it tells me who to call and how much they're responsible for. And that's where you can get to the root cause analysis. That's what you need to be armed with when you make that phone call. Or you go see that person in person, because let's be more personable than just phone calls or whatever. You go talk to that person and say, hey, I don't want to fire you, or whatever you say. Then you can get to the bottom, because we had a bunch of different reasons why you might have high direct labor costs. You came up with a bunch of reasons on Thursday. Maybe working overtime. Maybe we have people who aren't as experienced. We have a lot of turnover, things like that. We can take this number and start to drill down to why why it exists. We have all the equipment we need now to ask the right questions of how to improve it into the future based on which of those causes it might be. Okay. All right, I think that's what I want to say about that. Great. Let's move on to direct materials and why it's different. Direct materials is different and leads to, I want to go to this so you can compare it. Direct materials, it plays that differently. So with direct materials, we have one event, and then maybe in the same period, maybe not, we have a second event. So you buy a direct material, a raw material, wood, metal, something prefabricated, or whatever, and you buy it and you store it in your warehouse. And then, at a future time, you use it. But there's a gap between those two. Okay? You do that with direct materials. You don't do that with direct labor. That's called kidnapping. Can't take direct labor and store it in the warehouse to use later. Also jail time. Well, for direct materials here, that's like the best joke of the class too. So I'm glad I got a few Snickers. That's like my favorite anyway. I don't know. So we have direct materials. We're going to debit it. Sorry. Let's start with the same principles. Full actual, how much we actually owe for the direct materials. That's by law required. So we're crediting accounts payable for $1,000. In this case, we'll go on to the exact numbers of why, but let's just go with those numbers and assume they're correct. We have an actual cost of $1,000. We debit to accounts payable. And at that point, we know what the price variance is because we know actual price versus standard price. We don't yet know at all about how much it's been used. We don't know anything about the quantity yet. We just don't, that hasn't been determined yet. But we know we bought it for a certain amount. We know we should have bought it for this amount or this price per unit. So we can record the price variance now. So we're going to have here the flexible budget amount. Full actual here, far left side, not far right side. Full actuals here. And we're going to take the price variance out of it and have the direct materials account recorded at quasi-budget, as I've called it. So let me rebuild. I'll move up. Let me rewrite the flow of inventory accounts here. RM or D direct materials, direct materials, raw materials account. It's an account to reflect the value of what is being held in the warehouse for future use on the factory floor. And so we're going to go at like half standard in this account so that at WIP we can be at full standard. Okay? When we record the entry debiting to this account, the direct materials or raw materials account, we record it half standard at quasi-budget, at the budgeted price or standard price, but the actual quantity. So this is only half as inaccurate as this is inaccurate. Like I said, we're doing it a tactical inaccuracy here. We're saying we know it makes it untrue to record this at full standard, but we have to do that so that we can pull out the necessary information so the accounting system can help us improve profitability in the future. And this is halfway there. This is recorded at the standard price, but the actual quantity. And so then when we take those materials out of the warehouse and put them on the factory floor, we're going to credit direct materials account because we took things out of the direct materials account, out of the warehouse, and we put them onto the factory floor. And we now know how much we used to create whatever we created this period. So now we know what the quantity variance should be. And so now we can compare the quasi-budget, which is what direct materials is recorded at, versus the flexible budget or full standard, which is what WIP is recorded at. And so the difference between those two would be the quantity variance. It all fits nicely together. All right, so the direct materials account here and payable WIP, all these are the key touch points here. We have accounts payable at full actual, direct materials at half actual, half standard, WIP at full standard. And then it allows us to peel off a quantity variance and a price variance expense account right here. And note again, as promised, there are 3 lines in each entry. And so you can deduce relatively easily one of the lines. WIP is at full standard, accounts payable is at full actual, and you can calculate one of the other lines and then not have to do a price or quantity variance calculation. If you prefer not to. You can use this journal entry system to help out with that. Okay, and that's actually where we don't cover the overhead variances, or the next 7.7 I think is, 7.8 must be. Yeah, mix and yield variances. Those are for next week. All right, so let's run real quick through these entries right here. So here we have some rare earth metal, I think is the example I use. Yeah, 10 ounces. We bought 10 ounces for $100 per ounce. So we actually did this. 10 ounces is the actual quantity. So let's build up the fact pattern, just like we did above. We have actual price, $100 per ounce. Actual quantity, 10 ounces that we purchased. So we have to have additional terms. Actual quantity purchased is no longer AQ, it's AQP. What is our actual quantity purchased? 10 ounces. Okay, the standard cost would be, standard price, excuse me. I should edit that in the book. Standard price for materials is only $80 per ounce. We'll get to AQU in a second. Standard price, $80 per ounce. And we're only worried about those three right now because we only need those three to calculate the price variance. So when we get down here, do I have it? Okay, let me go up to the mountain and talk for a second about direct materials and what it looks like. So direct material mountain actually looks like this. AQP times AP. That's full actuals. And then we have the quasi-budget that we use. I'll put that on top like there. The quasi-budget that we use for our price variance. And that is AQP times standard price. Because we're doing price variance, so that's the lever we're going to pull. But then we have a different quasi-budget we're going to use when we're doing the quantity variance, which uses actual quantity, but actual quantity used times standard price. And we're going to get the quantity variance, comparing it to standard quantity, standard price. So depending on which variance you're looking at for direct materials, you might use a different actual quantity. So we need actual quantity purchased here because that's what's going to be relevant to that decision maker. The purchasing manager for the direct materials has control over the quantity purchased. So you want to be calling that person up with a dollar amount related to the decision that that person actually made. Whereas if you used some actual quantity used, at least part of your number that you're delivering to this person and saying, let's do something about this, or if it's favorable, congratulating them on and seeing how they can continue that in some way, would at least partly be due to the production manager who decides how the materials are used on the floor, that person's decisions. And so you're mixing responsibility streams here. And so that's why we separate them out. Actual quantity purchased times actual price minus actual quantity purchased times standard price for the price variance. And then actual quantity used times standard price minus standard quantity times standard price. Now that creates one substantive difference between this and direct labor variances. So with direct labor variances, you can take the price variance and the quantity variance, and if you sum them, you will get the variance, the overall flexible budget variance is what this is called, or spending variance, I hear it in some textbooks as well. It will sum nicely and neatly because these all use the same terms. That's not true here because we have this gap. What if actual quantity purchased and actual quantity used aren't the same thing, which is very, very likely they are not. You have that warehouse for a reason so that direct material levels can go up and down, which implies a difference between when you're purchasing the quantity in which you're the quantity and or schedule in which you're purchasing them and the quantity and or schedule in which you're using them out of the warehouse. The answer is the direct materials inventory account itself. it is a repository of that difference. So on the balance sheet there, it's holding the difference between actual quantity purchased and actual quantity used. It's going up and down with that. If you add in this plus these two, you will get that amount. And for those of you who really want it to be symmetrical and really want it to be in harmony, I've saved your bacon here. I've saved your sense of peace. And so let's look at that in this example. So like the example I scrolled away from. So right here, there's a $200 difference. It has to be the debit direct materials. I didn't even go through the calculations in this one. I said, look, I know there's $1,000 actual cost, and given our standard of $80 per ounce, for 10 ounces, it should be $800 at quasi budget, half standard. That's a $200 difference. That has to be the price variance right here. We could also calculate it out and say actual price minus standard price. So 100 minus 80 times actual quantity purchased. Well, in that case, that's 10? So we have 20 in here times 10, 200. So it ties and works well. Great, and the quantity variance now. Now, here we have actual quantity used is 7 ounces. So during this period, we used 7 ounces. Again, that's going to be entirely separate from the question of how much we purchased, or at least as far as the variances are concerned, it's a different decision maker, enough of a different decision maker to allow it to be completely separate from the question of how much we purchased. So 7 ounces of rare earth metal are put into production. So that we can now credit direct materials $560. That's what it says right at the top of there, which is the standard price of $80 per ounce times the 7 ounces used. It's $560. So we're crediting $560. And the standard quantity I'm telling you is 6 ounces. To produce, I just tell you this in this example, to produce the number of finished goods that we actually produce, we should have used only 6 ounces. So we use an extra ounce of rare earth mineral here compared to what we should have. So we have that 6 ounces standard quantity times the standard price of 80 gives us a debit to WIP, or full standard of 480. The plug in between them, $80 there, has to be the quantity variance. Or we could also figure it out with the equations and say we have actual quantity used minus standard quantity, which is 7 and 6, so that's just 1 in the parentheses, times $80 gives us $80. Okay, and now if we track this through, we've got a total amount of $520 we have to account for. Full standard's $480. The full actual is $1,000. We have $280 of it accounted for by the by these two variances. So 1,000 minus 480, and we take away the 280 from the variances. We have 240 unaccounted for still. Well, that 240 is sitting here as a debit balance. If you do a trial balance here, it would have a debit balance of $240. 800 minus 560 equals 240. That's where it's sitting. Okay, let's do some problems. Let's get into some of the meat of this here. All right. Here's a good one. I already set the fact pattern out for you here. I'll make a note about what this is saying right here in a second. But I can see that from the question stem, I'm asking about direct materials variances. So I'm going to want both variances. Again, just ignore volume variance, except in the case that you need to make sure it's not included in your quantity variances. I don't ask for those variances. So the direct materials variances are going to be referring to the quantity and price variances. Looks like we have a budgeted volume of 1,000 units, actual volume of 1,200 units. And here are all the details we need. Okay, so it looks like actual price versus standard price is right there. We have two different actual quantities of used and purchased. And then standard quantity is given in a per finished goods unit amount. Because I want to give you a chance to get the question wrong. I want you to take that 3 and multiply it by the wrong number down here. I want to tempt you to act like the difference between quasi-budget and static budget is the quantity variance. And it's not. It's quantity plus the volume variance. It's confound those two. So we need to be picking the flexible budget. What is the what makes this budgeted quantity different than this budgeted quantity right here? Anybody remember any of the mnemonics or ideas, or just from your sheer intellect you know, because you just love this stuff or you remember it? Photographic memory. What makes the flexible budget different from the static budget? Yeah.
The flexible budget is using the actual quantity that we used multiplied by our standard cost.
Yeah. So flexible budget uses our standard quantity per finished goods unit times the actual volume of finished goods units we produced. Is how I interpreted what you said. Yeah. Whereas the static budget uses the budgeted number of finished goods units we produced times the standard quantity of material units, in this case, direct material units per finished goods. Because the problem we're trying to solve here is there are two different types of units. It's like we're in a, you didn't realize it, but this chapter is about foreign exchange. You know, we've got dollars and we've got euros. And we can't do calculations in either one till we convert it to the other. So we've got finished goods units and we've got input units. I say input because it could be direct materials, it could be direct labor, it could be some form of input. But we've got some input. And the standard quantity here tells us what the exchange rate is. It's 3 direct materials units per finished goods unit. And so if we're converting from the budgeted quantity, the budgeted finished goods units, using that conversion, it equals one thing. And if we're converting the actual finished goods unit, it gives us a different budgeted quantity here. When I say it gives it one thing over here, it gives us one budgeted quantity. Here it gives us another one. So let's go into the Excel spreadsheet. Let's have something to show for our work here today. This is our DM variances question. And let's grab all the data here. In fact, let's see if we can cheat the system. And it works well enough. And then we also have 1,000 is our budgeted finished goods, and 1,200 is our actual finished goods or volume. I'm going to use that interchangeably. So we have 3 as our standard quantity here. I'm going to be tempted to multiply that by the 1,000 and say, oh, well, it's budgeted. I need a budgeted quantity, so the standard quantity times a budgeted quantity. That should give me 3,000 quantity of DM units. That's the far right-hand side. Well, it is the far right-hand side. Too far for what we're looking for. It's the static budget. That's wrong. That's what you're going to be tempted by. If you did that, you get 3,000 standard quantity used. I'll just go through it so you see why it's wrong. You subtract them. You have, that's the difference inside the parentheses. Times that by the standard price. 1080 is one of the wrong answers available. Tempting you. Don't give in. Instead, we need to figure out how many direct materials units should we have used given our actual volume of production. If we were doing our best, if we were on our game, how many direct materials units would we use? That's what we're trying to compare against. Not like how many did we say we're going to use before we knew what the volume would be this year. So 3,600 is our standard quantity, meaning the total standard quantity built by this standard conversion from finished goods units to direct materials units. And so what I'm doing is I'm saying dm quant variance equals actual quantity used minus standard quantity times standard price. So I want to know the standard quantity here, and I know the actual quantity up here, and I know standard price up there. So I want AQU minus SQ, put in parentheses, use F2 so I can edit the cell, and I want to multiply that by standard price. So 3,600, something's not right then. Oh, I scanned through the price variances really quickly here and didn't see any that were 3,600. And I'm like, I'm wrong. No, the quantity variance is here. So it's this answer right here, 3,600 unfavorable. And is it unfavorable? Well, let's see. We actually used 3,900. If we were on our game, we would have used 3,600. Yeah, using extra direct materials to produce the same number of finished goods, that's bad. It's like, if that doesn't hit quite the same way. How about to get, let's say you want a B in this class. To get this class, is it better to take it once or 3 times? Once is better, right? Like once is more than I can handle. Okay, just lay off me. Yeah, to get the grade you want, you would rather get it once. What that suggests is other attempts were bad. 300 extra units used. What happened? They fell off the truck. They got stolen. They got wasted somehow. They got broken because we didn't manage them right. They got left out in the rain. Who knows? Lots of different follow-on questions we can ask, but we know the right person and the right amount to ask that question about. But 300 extra units used to produce 1,200 finished goods units, that's not good. So that's $3,600. Let's see, these two are dollar amounts. And technically, we know the answer now. We don't need to keep going. Here I was tempting you with this 1,280, or 10,800, excuse me. I didn't engineer the question so you would get it. You'd have to do both of them necessarily. We already know the answer. I don't have a different, regardless, let's inside baseball. Let's talk about how we do the price variance. Direct materials price variance. So if they aren't memorized for you, I don't expect you to memorize these necessarily. Sorry. I am realistic about whether you want to memorize all these equations in this chapter. Good opportunity for your note page. Lots of equations in this chapter. And put them don't just copy them over from the textbook, put them in the terminology that you will recognize because you've done them for the quizzes and so on and so forth. In fact, maybe this isn't, you don't have to do this, but this is a possibility. If this works well for your system, maybe you make a note page now, at least what you think you're going to put on the final note page with regard to chapter 7, and use it during the quiz this week. So then you're looking at the same equations and you're used to it. Gets you some reps with the same environment, same conditions. Okay, so equation goes like this. I know I want price variance, so I know that inside the parentheses I'm pulling a lever. This is how I remember it. I don't remember it because I memorized it. I just remember it because I've created. All right, I don't trust my memory, to be quite honest. So I tend in everything I do to create little breadcrumbs because I know I'm going to forget it. So I'm like, okay, well, how can I make myself remember this and relearn it when I need to in the moment? And so, I know price variance is over on the far left side, so it's actual scaled by actual quantity. So I want to pull actual price versus standard price. That's the lever I'm pulling, the comparison I'm making, and it's scaled by actual quantity. Actual quantity purchased. So price variance with a P uses actual quantity purchased with a P. AQP for price variance. Also another way to work it if you want. All right, so we have actual price We have standard price. Let's copy it down from there. And actual quantity purchased, if I could get it, I gave to you 4,000 units. All right, so we have, start with the parentheses, actual price minus standard price times actual quantity purchased. So 4,400, yeah, that confirms it. And it's unfavorable because, yeah, we paid $13.10 for each direct materials unit. Our standard was $12. So that's extra. That's some premium we're paying. Why do we have that premium? And yeah, we might get on the phone and they say, well, yeah, it's just the price now. Like supply chain issues or lots of demand for this product now or whatever. And if they can back that up, then maybe we change the standard with some consideration and cool heads. But we know the right question to ask. And now we have better ability to forecast into the future. We're making the static budget for next year. We would then have an updated standard price for this direct materials unit. And maybe we realize, hey, this line isn't really profitable anymore because we've been priced out of the market. Or we got to make some efficiencies in our procedures. We got to go through that. We got to go back to chapter 5 and do activity-based management, see what kind of process improvements we can make to get this product line to be profitable again. All right, so that's our DM price variance. This is our direct materials price variance, quantity variance. I am committed to varying direct labor versus direct materials instead of quantity versus price in this question. I don't know why. My brain really wants to do that. Great. One question. Oh, and now we get an open answer one. I'll skip over it for now. I want to get to some entries. All right, let's look at some entry ones because this is another wrinkle to this quiz that I want you to have time at. It's a little prettier when it's full screen. When it's half screen here, it looks a little uglier. All right, so Boomerang Corporation produced 100 units of product AA190X. The total standard and actual cost for materials and direct labor for the 100 units of that product are as follows. All right, so I give you the standard amount. I give you standard pounds per pound, and standard quantity here, 200 pounds at $3 per pound. So standard amount. I give you actual quantity of direct materials and the dollar amount per pound and the amount. And this question, this version of the question anyway, asks about the labor variances. So it's all about this stuff down here. In fact, we can ignore these up here. But it's okay we went over it because they follow the same pattern. We've got standard quantity, standard price, actual quantity, actual price. So full actuals here, full standard here. And we got to pull out which of these is right. So let's just start with process of elimination. Which of these do not look like the 4-line entry that you saw in the textbook? Yes, thank you. That's keen observation. Yes. This is wrong and this is wrong because there's no variance being recorded. These 2-line ones don't work at all. So what is the difference between this one and this one that are left? It looks like I'm varying the name of these two accounts. Labor price variance is getting a debit of 552 in this example, this answer. I'll scroll up a little bit for the video. And quantity variance is getting a credit of 480, Whereas over here, price variance gets the credit of 480 and quantity variance gets the debit of 552. So it still balances just fine. It should still balance just fine. 6,552 worth of debits total, and it should be 6,552 when you add that up here as well of credits. So the balance is I've just swapped these two words. So we got to figure out which one of these is true, is accurate. Now, remember what a debit means? Is that a favorable or an unfavorable variance when we're debiting to the variance account? I heard unfavorable. Yeah, it's unfavorable because a variance account is an expense account. So we're debiting to it. That means it's going up. That's unfavorable. More expenses for the same amount of output, unfavorable. Okay, so I can, just without doing any calculations, we can solve this problem. 400 is the standard quantity of hours. 368 is the actual quantity of hours to produce those finished goods that we produced. Is that favorable or unfavorable? That's favorable. Yeah, we saved time. We were cooking. Insert Walter White joke right there. That's favorable. So we can't be debiting to the quantity variance account. We have a favorable variance. We need to be crediting to the quantity variance account, just based on this comparison right here. So it has to be this answer right here without doing any of the calculations. So what I want, and it's maybe a dream, but I can dream, right? What I want is by the end of the week, you to say, wow, adding the journal entries made these questions easier. At least lie and say that to me. Yeah.
Will it always be like that? Like, you can always spot that difference? Will that always be this in the right direction?
With this exact setup, this would. Yeah, I want to say yes. I'm trying hard to say yes. Yeah. I might set the questions up a little differently, the other ones, and I don't quite give you the layout. I don't swap them credit to debit. But if in this situation, that'll always be true because the variance accounts are expense accounts. They're always going to be going up with unfavorability, and I can see right there just by comparing the quantity whether it's favorable or unfavorable. Yeah. And we do the same thing with the price here as well. We expected at standard to pay $15 per hour, and we paid extra $16.50. Maybe there was an overtime premium in there or something like that, or just people getting too many raises. All right, let's put a pin in that. We'll come back to that in right at the end of the class. Okay, just if I forget, tell me to talk about raises for just a second. But yeah, I know that's unfavorable. All things being equal, paying more for the same amount of labor and same quality of labor is worse than paying less for that labor, at least at the company's perspective. And so yeah, we should be debiting the price variance because it's unfavorable and crediting the quantity variance because that's a favorable variance. So it has to be this one right here. Okay, so I'm not going to do the calculation. I want to do one more calculation, and we'll do this one. How about that? Nice, easy. I say that as a joke. Sorry, there's like a hole suddenly under here. There's supposed to be a little shield keeping the chair from falling into a hole, but the shield's kind of fallen away. I don't know what's going on down there. All right, so the question same is, what is the firm's direct labor price variance? Okay, so I can copy stuff over. So this is the open answer direct labor price variance. Now I have to modify this a little bit. That's first modification. There's the second modification. Because with direct labor, actual quantity purchased is actual quantity used. Again, kidnapping, da-da-da-da. Direct labor price equals actual price minus standard price, and then that difference times actual quantity. So I need those three. In fact, besides those three, I can ignore anything here that isn't relevant to that. So actual price, let me highlight, it's harder to see. Actual price, I'll label it to the right like I usually do. We have $5.20 per hour. Yeah, cover that right. And we have a standard price of $4 per hour. I made this problem apparently in the 70s. It's pretty low wages. Sorry, guys. Actual quantity is 583. That's right there. Actual quantity, in this case, is hours. 583. So I can do the equation now. I can put it in the parentheses, multiply the difference by actual quantity. That should be the answer. Let me double check here. Or if you see something, let me know. I could ignore this stuff here. Standard quantity, actual quantity, yeah. And then actual, I said it wrong. Standard price, standard actual price, and standard actual quantity, actual quantity. Okay, great. That should be our answer right there. Here, let me highlight this cell right here. Okay, so I've got one little last note to make. It's just signposting for future chapters. But after that, I will be done, and then on Thursday we'll go over more questions. So work on that quiz. I think I had a great idea. That just came to me. The idea of writing out how you're going to put the equations now for your quiz, so you're used to it. But if that works for you, great. The thing I want to note about raises. So here, in direct labor land specifically, some textbooks use different terminology for this. They call it the rate difference instead of the price difference, and they call it. I think this is where they use efficiency instead of quantity. I don't know if that's to save people's feelings, because direct labor is like actual people, and I don't want to talk about their price or the quantity of them, like their cattle or whatever. We're not talking about the people. We're talking about the hours that they're working and how much are we buying their hours for. That's what it is, the contractual arrangement to get their hours of work for the company's benefit. And talking about the quantity of hours and how many hours we used, I think it's just fine. I have erred on the side of uniformity between all the different terms. Always price and always quantity. Those terms are what I use. I said it's unfavorable to have a higher price, earlier question here, a higher direct labor price here. But I wonder if this isn't a very realistic example, because that higher price maybe got us better labor and got it done faster. Maybe there's a trade-off going on there. That idea of, is it always unfavorable to have higher wages for your workers? It kind of presages some of the shortcomings of standard costing here, of variance analysis. It kind of assumes that you want to squeeze every last drop of blood out of your workers and efficientize them to death. That kind of what it naturally just gravitates towards. Chapter 8 basically is a modern critique of that. Lean accounting basically methodology in general tries to critique that idea. Anyway, that's just to get us thinking about what comes next after spring break. All right, thanks.